Are you thinking about retirement? Maybe you're a retiree right now, maybe you're a pre-retiree, maybe you're really young and you're just curious. Well, today we're going to deal with one of the biggest risks of your retirement. Now, you may be asking, what is that risk? Your risk is, well, the big risk is the withdrawal rate. So imagine you have 500,000 saved up in investable assets, or maybe even 1 million, but say your withdrawal rate is 500,000. Obviously, the chances are, especially if you live a long life, that will not be enough to sustain you. So withdrawal rate is super important and something that you have to consider because it's one of the biggest determinants on how far your portfolio goes and how much money you have such that it could sustain you for all of your retirement. Now, here's a question you may have. You may say, well, how does the market affect my retirement savings and market trends? Because really, a lot of the assets that I'm going to pull from are invested in the market. Well, the value of your savings can change a lot, right? Because you have market trends. Now, this happens when the stock market moves in a certain pattern. It might be up 5% or 6%, it might be down 2%, it might be sideways 0%. Um, this is what we call the sequence of returns. Now, if the market goes up quickly, your savings grows, and that's good for a little while, right? So that's amazing while that's happening. But if the market goes down, it can make your savings last a much shorter time. And by the way, the question might be, if the market does badly, what's the chances of that? Here's the bad news. Every group of people who retired has faced a bad market at some point. And when we say that, we're talking about people who have retired, say, age 65, and has, they've lived, say, to life expectancy 86, 84, and we know that's becoming, longer. So let's say 94, 96, thereabout. Every group of people who retired has faced a bad market at some point, right? Because longevity is a risk multiplier, meaning the longer you live, the more risk you will face, and the more risk your portfolio will also face. So it's not a matter of if it will happen, but it's a matter of when. So the big question is, will it happen early in your retirement or will it happen later in your retirement? And the other thing is, how will you prepare for it? No, let's stay a bit with the sequence of returns, just so you have a clear understanding of it and how it works. So the question you may be asking is, what exactly is a sequence of returns? Well, you can look at it this way. At least the question you should ask yourself is, who's paying for your living expenses when you retire? If your savings are growing and covering your costs, that's great. And you're what we call, you're lucky because the market is helping you. But if you have to use your own savings to pay for your costs, that's not so great, especially if it happens early in your retirement. And that's because you have this amount of money saved up. And let's say the market drops, say, 30%, and you're affected by that, and you're down, say, 30%, or maybe even more. And you have to pull from that amount. You're already down, and you're pulling from that amount. It really takes away from your opportunity to bounce back, for the portfolio to compound and grow. So that's one of the simplest way I really have I've seen the sequence of return being discussed. So the next thing you might say is, how do you protect your retirement income in some ways to reduce this particular risk? Right? Now, first is you have to diversify your portfolio. When I say diversify your portfolio, it doesn't mean you have five, six, seven, eight, 10 different accounts and they're all invested in the same thing, or they're all invested in, something providing a 1% or 2% rate of return. That's not what we consider a diversified portfolio. And speaking on that, there's also the concept of inflation, which we have to think about because that significantly affects your portfolio. And we know inflation. With inflation is every year the value of your money essentially decrease, and so you have to have assets that are increasing, that are outpacing inflation, right? Because then what's happening is your portfolio is increasing. So one of the things you want to do is diversify your portfolio. You want to spread it across different asset classes, um, Canadian stocks, US global stocks. You may want to look at real estate or other investments, depending on who you are, your risk tolerance, your suitability, things of that nature, because a diverse portfolio helps to reduce the impact of the downturn in any one part of the market. So if you're a particular sector that does badly, you have, enough diversification that can protect you. Now, you could also be over diversified, but that's for a different video. But you want to have a proper diversified portfolio. Essentially, you don't want to have all your money in one particular category, because if something goes badly, then you're you essentially will have a significant drop in your portfolio, overall portfolio. Whereas if you're properly diversified, yes, you'll have a drop in your portfolio, but hopefully you're properly diversified that the other assets are able to protect you. The other one is using a dynamic withdrawal rate. We talk about a withdrawal strategy. We talked about withdrawal rate and how important it is. You have to look at how much assets you have. You know, look at your accounts. Look at what you're getting in any type of pension funds, and look at how much is that you're gonna have for the rest of your life, and anything above that that you will have to come up with. You have to look at that and see, okay, how much can I pull from that? So you have to adjust your withdrawal rate based on how your portfolio is performing. And in good markets, you may have the opportunity to withdraw a bit more. In bad years, you take out less. Or if you have alternative assets that you could pull from, that may be something you want to consider. Now, if you have this flexibility and you've built in this flexibility, this will protect your savings when the market goes down. And this is something that you should be considering right now, especially if you're, building into retirement. They always say a good time at least to start is, at least 4 to 5 years. So you have 20 years ahead. Even though planning way before that, there's nothing wrong with that. It's just, most people age 65, at least a good 20 years. And that doesn't mean you should start investing before that. That means it's from a planning and strategic standpoint, and where you allocate assets is something you want to consider sometime beforehand because of situations like this. You want to adjust your portfolio in such a way where you have the flexibility and that your assets are properly protected. Another one is the bucket strategy, right? So you want to divide your investment savings into different buckets for short-term, mid-term, and long-term needs. Why? Because there might be short-term needs, and you probably do not want to have those assets uh, to have those assets deal with the sequence of risk, right? So you don't want to have a significant, you want to have a significant proportion of your, your portfolio dealing with the fluctuations. You want to have at least a certain part of it midterm and then long term. So how would this look? So for example, for 1 to 3 years, you may have something that is a lot more conservative. It's protected. You might keep some amount of cash depending on how much you will need. Of course, you have to consider an emergency fund, or if you have a short-term need for cash, you might keep that in a high-interest savings account. These days, it's great, but we know that interest rates right now are on a downward trajectory, so you might not get as much protection as you used to get before. You also may want to consider low-risk investments like GICs and lock those in. Again, in the recent months, those have been providing good returns. Let's see what happens in the future. But a lot of times for the short term, you're not necessarily looking to shoot out lights and get high returns. Why? Because you're putting your investment in some type of a safety account. That way you're properly protected. Then you have the midterm, which is somewhere around 3 to 5 years, and then you have the long term, 7 to 10 years, right? Again, this is something that I think you should be speaking with your investment advisor. But essentially, what you're doing is you're creating an approach that reduces the need to sell investments during market dips. Now, if you have that short-term accounts, those short-term accounts will protect you if the market dips because, well, they're protected and they're not participating in the market and not dealing with that downward trajectory that the market may be facing. Another one is consider guaranteed income products. I know it's a bit controversial because a lot of people don't like annuities, but you look for guaranteed products. And for some people, annuities may be the way to go. These products transfer the investment risk to the insurance company and ensure lifelong income. And there are several flavors of this, and I'll probably make a video about that one day. But this is something to at least consider. I'm not saying you should necessarily do it, but it's something you consider. In fact, all these strategies are things you should consider. And after, looking at your situation, decide which one makes the most sense for you. The other one is delaying CPP and OAS. And why is that? Because when you delay CPP and OAS, and this is the Canada Pension Plan and the Old Age Security, the benefits increases. And what it does, it provides a higher guaranteed income and reduces the pressure on your investments, in the years that you retire, right? So What you may want to do is delay, especially if you are, pushing retirement back for some time. You also want to delay it at that particular time for other tax purposes. But it gives you this guaranteed income, and you'll be receiving this money for as long as you live. So if you're delaying the CPP and OAS and it's at a higher amount, if you're receiving a higher amount, then of course what that will do is take some strain off your investments, right? So that's something else to consider. Hopefully this was helpful. I know that it is one of the things that can get a bit dicey, so I always recommend either speaking with an expert, working with someone who's going to provide you with a financial plan, or maybe look at additional resources. But I strongly recommend to not do this halfway, because you do not want to have to retire twice, meaning retire, come out of retirement, and go back in again, because you missed it on the first chance and the first go round. So hopefully this was helpful. If you do, like, share, subscribe. You could also reach out to me and I could have a one-on-one discussion with you. Take care.